Yeah, welcome back. And this is again our small little lecture on EU law and taxation. Last time I spoke to you about what is a discrimination on grounds of nationality, how can we check that? And so it can nearly be no surprise that this time the topic will be what's a restriction. So the second thing which is forbidden by these fundamental freedoms of EU law. So let's just begin. You will probably remember, that is my polite expression for I damn hope that you did not forget that a restriction of a fundamental freedom is any measure which either hinders the usage of such a freedom or makes using it less attractive. So, not only measures which hinder the usage, let's say, of freedom of establishment, but every measure which also deters you from using it, so which makes it less attractive, a bit less attractive or much more less attractive than something else. We have also seen that such a restriction might be justified, so it is explicitly allowed or implicitly tolerated by the treaty. And this leads us up, all in all, to a two-step test if a restriction is a forbidden restriction of a fundamental freedom. The first step will simply be, can a measure be seen as a restriction at all or not? So then, if it is a restriction, then and only then you enter into the test if it can be justified and is so implicitly tolerated by the treaty. There were four criteria. I hope you remember them. The first is, does the measure have a legitimate aim of public interest or public policy? Is that measure at all able to reach that aim, or is it a nonsense measure? Is the measure excessive? So does it restrict the fundamental freedoms more than it would be necessary to reach that aim? And the fourth aspect was, is the problem in question, so the problem which you need that restriction for, is that problem dealt with in a non-discriminatory way? These last three aspects also sometimes go in literature and jurisdiction under the headline of the restriction must be proportionate. So the proportionality of the measure, that means there must be the right proportion between what the measure inflicts to that fundamental freedom as a damage and the importance of that public aim which one follows. Yeah, so let's have a closer look at this definition and think about the details. First, you must remember something which is also the case for a discrimination. The problem, if something is a restriction or not, first has to test if the problems just come from the fact that the national laws in different member states are different. If the mere fact that the national laws are different causes the problem, then the problem cannot be reproached to the solution which that one single member state has chosen. Because then it's not the measure in question which poses the problem, but only the effect or the situation that different measures are in place in different states. So the only way to avoid the problem then would be to take care that all the states have the same solution. But that could not be done without a political decision, so without a directive or a regulation on the EU level. And so you can't demand that by jurisdiction. Well, do we have a test to check this first question? And the answer is yes, naturally we have, because plain and simple, if you think about a certain national rule and want to find out if it is a restriction or if just the difference of the laws creates a problem, then just use your imagination and imagine that the rule in question, the one which you're going to test, is exactly in the same way existing in all other member states too. If your problem then vanishes, oh, okay, then this is the proof. The rule in question itself doesn't create the problem, but only the fact that the other states have a different solution. You cannot reproach that then to that first member state. They evidently chose a solution which does not really affect the single market. Only the chaos in the market leads to the problem. So, in that case, not a restriction. The rule in itself doesn't pose a restriction. A standard example would, for example, be the income tax rate in state A is only 20%, in state B it's 60%. Now, 60% is definitively very unattractive for people who live in state A. They, for example, are strongly deterred from moving their residence to state B. So here we have an effect which is a kind of an obstacle to one or perhaps several of the fundamental freedoms. But now let's, in our imagination, replace the laws of all other states by the same law as state B has. So all other states also now have a tax rate of 60%. Is the problem for moving still existent? And the answer is no. If you live in a state where 60% is due and move to a state where also 60% is due, the difference in the tax tariff plays no longer a deterrent role. The problem is gone. So it's not the 60% rate in itself which poses the problem. It's a question, well, the underlying reason is that other states have other rules and that therefore sometimes changing the state and changing into another legislation is combined with disadvantages. On the other hand, the problem would also naturally vanish if all states had only 20%. So you cannot find an argumentation that one of the two solutions is automatically wrong. Both of them are okay. And only the question, or only the effect that every state has a different solution creates problems here. You cannot get rid of that without a central decision. So, for example, without a directive which then says everyone has to have the following tax tariff for income tax. But such a directive doesn't exist, and as long as it exists, you can't demand of any of the member states to stand down and to back down on their own solution. Well, so then it's not a restriction. Another example, state A has a rule that you need to pay an exit tax on all hidden reserves in your property if you leave that state and move to another member state. So if you have years ago bought shares in a GmbH for 1 million, and now due to a very lucky course of events, the market value of the shares is now 100 million. You have hidden reserves of 99 million, and now if you move and leave that state, you will be asked to pay taxes on that hidden reserves. For example, if you move to France. Now, test, is this a restriction? Now, let's just imagine, not only Germany, but also France, Spain, Italy, they all introduced an exit tax rule. If somebody leaves the state, you have to pay an exit tax on all the hidden reserves, on all the gains which have already been caused during the time where you stayed in that country and which are not yet formally realized. Now, if you imagine that you still have a problem posed by the exit tax, It doesn't change if everybody has the same rule. Then you have everywhere at each border the same problem, but you still have a problem. So the negative impact of that rule doesn't vanish if you imagine they all have the same rule. So this rule is clearly a restriction. This rule makes crossing a border less attractive or even hinders you. Yeah. So if we take that into account, we might even improve our previous chart by a little detail. The first step should get some bullet points, not only the second one. So first step is, does the rule in question make the use of one of the freedoms impossible, so hinder it, or less attractive? And second, would the effect vanish if all states had exactly the same rule? Because in that case, we do not have a restriction. Good. So, does something hinder the usage of a freedom or make it less attractive? The problem of the less attractive test is you need a comparison. So, with what will you compare? You could say, in principle, we compare with the state of the matter if that rule were not existing. That would be relatively harsh, because nearly every duty which you impose on somebody would then be less attractive as if the duty were not existing. So that is probably the wrong comparison. So the comparison which the European Court of Justice usually makes in order to find out if something is a restriction is they compare what the law demands in the exactly comparable inland situation. So one could draw the conclusion that a restriction is, when it comes to the less attractive test, the same as discrimination of a cross-border activity in comparison to an inland activity. So, and this is indeed what is mostly tested. How can you test if that criterion is fulfilled or not? Well, my first recommendation would be, make a sketch of what happens in the cross-border situation. For example, in our exit tax situation, we have the taxpayer's home first in the inland, then we shift it over the border abroad, and we get an exit tax of 99 million. Now you make a sketch with exactly the same situation happening in the inland. Taxpayer has a home, taxpayer changes home to another location, but now by definition in the inland, and so, surprise, no exit tax. And here you see, okay, everything has remained unchanged. The only circumstance which was changed was the location to which our taxpayer moved, and yep, the problem vanished. That means evidently we have here less attractive or more drastic consequences in the cross-border situation than in the inland situation. So yes, it is a restriction. And if that problem doesn't vanish, if the states have exactly the same rule, then yes, then it is a restriction. Okay. So a variant of the question, if the obstacles for the functioning of the fundamental freedoms are only caused by the fact that different member states have different laws, a variant of that thing is also that problems can arise from the fact that the law of a member state applies to certain events and not to others. So it can also arise from the fact that some things are not covered by the same legislation like the others. You know such problem already. Remember, please, when we talked about potential discriminations on grounds of nationality, in the inheritance tax, there was a rule which says if you move away from Germany, and you are a German national, you will be subjected to an extended, unlimited inheritance tax liability for a period of 5 years after you left. Now, if you are not a German national, then not. And we already discussed that this probably is not a discrimination, or at least that it's difficult to call it a discrimination, because you could also explain this difference by the fact that under international law, Germany can apply its rules to German citizens and what they do abroad. Whereas if a foreigner lives abroad, international law does not permit to you to regulate what the foreigner does in the foreign country. So the different treatment here could probably be due to the fact that this is not an injustice built in the rule, but just due to the fact that, well, the one person can still be subjected to the inland jurisdiction or inland legislation in such an extensive way, whereas the other persons can only, due to international law principles, only subjected to German taxation now with what they have or do in the inland. So unfortunately, that follows from the scope to which you can apply your laws, and not from an unequal treatment of people by the law to which it is applicable. So exactly the same constellation can also show up in cross-border constellations. For example, if you have a business with a profit of plus 100,000 in Munich, and you have a second permanent establishment, a second business with now a loss of 100,000 in Cologne, you can add up the two results and have a total taxable income of 0, so no taxes this year. Now, if you have a business of 100,000 in Munich and have a second business with a loss of minus 100,000 in Paris and France, then you cannot add up the loss with the profit, and you end up with a taxable income of plus 100,000. One could say this is a different result and definitively less attractive in the cross-border situation. Now, it might be that the decision to ignore the loss from Paris, that is due to the exemption method in the double taxation treaty, and now one could interpret the exemption method as an agreement between Germany and France. Well, for the French permanent establishment, German tax law does no longer apply. Germany exempts it. So Germany agrees to the French PE, only French law applies. If you interpret the exemption method in this way, Germany renounces on its right to legislate on the foreign PE in the tax area, then the taking the foreign loss no longer into account just follows from the situation or from the decision that German law does no longer apply to the French PE. So everything which would be covered by German law would still be regarded in the same way, but the French PE is no longer relevant for German law. And so the different treatment of the PE in Cologne and of the PE in France would just come from the scope of applicability of your own law. And as long as there are no rules which on EU level which say to which situation a state must apply its laws and to which situation not, you can sometimes say a different treatment results from the decision of a state not to apply its law to certain foreign situations. The ECJ has difficulties to control, check, or criticize such a decision because as long as you are approximately in line with common sense and reason and international principles, when you decide to which situations your laws shall be applicable and not, you cannot demand a different decision from a legislator. So this is also a possibility to talk yourself out of criticisms, and that has to be expected if you bring forward in a discussion with the fiscal administration that a certain rule treats a cross-border investment less attractive than an inland case. Now, there is no rule without exception. If, for example, in the double taxation treaty, two states would agree to delimitate the scope of their laws in a way which is clearly and plainly unfair to the taxpayer, that could be criticized. For example, if the rule in a DTT is the profits of the PE in state A go to state A, the profits of the PE in B go to state B, but the losses, if they occur, of a PE in state B go to neither state A nor state B, so that a certain amount of events goes to the nirvana, and that is systematically to the disadvantage of the taxpayers involved, that would be probably criticized by the ECJ, and there have indeed been cases where that has been criticized. For example, if a state says, well, we renounce jurisdiction or legislation on these events in full knowledge of the fact that the other state would also not take jurisdictional legislation on these events, and if we had taken them into account, that would have been positive, and in inland cases we would have done that, then you have a really bad stand in the ECJ. But if not, then not. So okay. Now let's try to find out our rules for what's a restriction, or test our rules a bit. Let's say, first example, you have an exit tax on hidden reserves in shares of a company. You are a shareholder, you leave the country, move to another member state. Is that a restriction? And the answer is yes, naturally it is, because if you move to another country, you pay an exit tax. If you just move inside your own country, nothing happens. And test, would the effect vanish if all states had an exit tax? And so on. The answer is no. So indeed, this is a restriction. Well, second idea, you have an exit tax on assets which are shifted from one country to another country of the EU to a permanent establishment in the other country. And well, such an exit tax for assets of companies is even mandatory under an EU directive, under the Anti-Tax Avoidance Directive of the EU. So you must even establish such a rule as a member state. Now, question, is that a restriction? And the answer is yes. Because even if all the member states have such a rule, it still remains the effect that if you shift a good cross-border, then that causes taxes. Whereas if you shift a good from one location in a member state to another location in the same member state, nothing happens. So yes, here something makes cross-border activity less attractive. Is this also covered by one of the fundamental freedoms? Yes, sending goods to another state would be the free movement of goods. Cooperating with or doing business and therefore transferring goods to a permanent establishment of yourself in another country would also be covered additionally by the freedom of establishment, and so on. So yes, it is a restriction, but you remember, a restriction can be justified as necessary under the treaty perspective. And if it can be justified by compelling requirements, then the legislation of the EU can even require how the member states have to deal with that problem, or that they have to deal with such a problem. So it is a restriction, although in most probability a justified restriction. Next example, controlled foreign companies taxation. You know that in the Foreign Relations Tax Act and many other tax acts of other countries, there is a rule that somebody who is a shareholder of a company which is in low tax state, so tax haven or tax oasis, has to pay an additional tax on the profits of that company to compensate for the too low tax burden in the foreign location. And in this case, you have to pay an extra tax if you hold shares in a foreign company, but not to pay an extra tax if you hold shares in a local company in your own state. So this is something which makes a cross-border activity less attractive. Furthermore, you have to pay this extra tax even before you get the dividends from the other country, from the other company. So even under a liquidity aspect, this is also far less attractive. And so it is definitively a restriction. A tax on hidden reserves is levied by, or in case where a taxpayer leaves the area of the EU. In principle, you could think about this as a restriction. If you cross the border, then you have to pay. If you remain inside your own state, you do not need to. But the problem is crossing the EU and moving to a third state is not protected under the EU treaty. So one might think that is a restriction, but of what? There is no freedom which could be restricted here by tax law. Under EU law, you do not have a right to move to the US, so the member states can naturally still decide to restrict that directly or indirectly. So a tax measure which makes moving to the US unattractive or nearly unaffordable is not open to criticism under EU law, because as long as there is no EU rule which could be violated or harmed or undermined by such a tax law, the member states are free to do what they want. Well, go to the second step. Justification. That is only tested if we are sure that we have to deal with a restriction. So now we can look if it's justified or if we can prove it can't be justified, so it's forbidden. Well, the first criterion was if the measure in question has a legitimate aim. Here you please remember that the EU treaty in itself does not say which states of member states' policies are legitimate or not. The only thing is a legitimate aim is every aim which is not illegitimate under the EU treaty. Now, illegitimate would it be that you have the aim to undermine EU measures, EU rules, or aims of the EU. So, for example, if you intend to keep foreign competitors out of your local market, that would be an illegitimate aim, because in the EU treaties you promise to have an open market where foreign competitors would not be discriminated and where they have access to your market. Now, if you say we promised free access to our market and then you say we want to keep the foreigners out, that is exactly the opposite of what you promised. So in that case, that would be an illegitimate aim. That this is forbidden follows from a treaty rule in Article 4 of the Treaty on the European Union, so in the basic treaty, which says the member states take the obligation to abstain from everything, every measure and every other action which might negatively affect the aims and the measures taken by the EU. Apart from that, member states can still do whatever they want. So even a nonsense aim of public policy would be legitimate. For example, if we introduce a tax rule with the aim to increase the number of free living red-skinned elephants in the gardens of inhabitants of suburbs of greater cities, That would be complete nonsense, but from the EU perspective, it is a legitimate aim, at least as long as you can't prove that there is, let's say, an EU rule on the protection of wild living animals which you harm by such a policy. Or even a state policy which aims at encouraging the population to believe that Elvis is still alive is probably nonsense, but from the perspective of EU law, not illegitimate, at least as long as nobody can point out that any measure or aim of EU policy is undermined by following such a public policy in a member state. Good. So very often you will have economic aims. We want to keep foreign competitors out of our market. We want to improve the standing of our people, and other things, to influence competition. That would be, we want to prevent a fair common market from working. By the way, what I did not explicitly mention with regard to discrimination is what sometimes shows up. That's the argument. We do not discriminate the foreigners. We treat them normally, in the usual way. We just give a privilege to our own citizens. Well, in that case, you have, again, a less favorable treatment to the foreigners, the regular treatment, than for your own people, the favorable treatment. In that case, it's automatically a discrimination. So it does not count, or it does not influence our judgment which of the two treatments you present as the regular one. No? The difference is what counts. With a restriction, that would be the same. To say, all the foreigners still get the regular treatment, our own people get a better one. This would also be a discrimination, or in case with cross-border activity is still treated in the regular way, inland activity just gets some favorable things on top. Also, that would be a discrimination of the cross-border activity, and so it would be a restriction. Yeah. But back to the aim, now you know under which circumstances an aim is illegitimate and when it is legitimate. So most aims of public policy will have to be seen as legitimate. The elephant aim, the Elvis aim, and several other aims would be all legitimate as long as you don't find any EU measure which might be impacted by that. Well, the second criterion was the measure must be able to reach the aim. That's understandable because we have seen that the elephant aim and the Elvis aim are legitimate aims. So I might always bring forward as a justification, let's say, of paragraph 2a, foreign losses are not deductible. We might say, well, this measure follows a legitimate aim, it follows the Elvis aim. Then every conversation partner of us would naturally ask, what does it have to do with the Elvis aim that you cross out foreign losses from the tax declaration? And we would just say, well, it is a legitimate aim. Okay, the measure doesn't have any impact on the aim, but this was our aim. And well, you said legitimate aim is sufficient, so we had a legitimate aim. Okay, not everything has good quality. We accept that our measure had a bad quality. It completely misses the aim, but it's legitimate. So this way you could justify everything, and that's clear that the second criterion must be tested. Does the measure really have a positive impact on the aim? You can probably not demand perfection, but if there's evident nonsense around, or if there is an evident mistake in the conception of the measure, then you can criticize it as something which does not need protection. A measure which doesn't reach its aim doesn't need to be tolerated. You do not need A nonsense rule doesn't need protection against a fundamental freedom, also a basic right. So if it's evidently insufficient somewhere, then you can say this measure doesn't deserve to be upheld, at least in a conflict with a higher rule. That is often difficult to prove, but there are cases when it leaps to the eye that the measure doesn't work as it should. For example, there was a historical case where Belgian law forbade Belgian citizens to buy Belgian treasury bonds, which were offered at the stock exchange in Frankfurt. The reason was the Belgian state paid the interest on that treasury bonds without withholding tax. And then the Belgian state says, if our own Belgian citizens are allowed to buy these treasury bonds, then they will commit tax fraud and will not pay income tax on the interest. And we want to avoid this. And so the treasury bonds are only sold to people who take the obligation not to sell them on to Belgian citizens. The justification was we want to prevent tax fraud by our citizens. Now, when that came to the ECJ, they said, naturally, preventing tax fraud is a legitimate aim. It's necessary to prevent that. Now let's check what happens if you forbid to your Belgian citizens to buy these treasury bonds. Then they will buy a mass of other investments which potentially are available to them and commit tax fraud there. So this evidently is a completely senseless measure. So it doesn't deserve any protection. It loses in the conflict against the freedom of movement, free movement of capital, sorry. The loopholes which were left open for Belgian citizens to commit tax fraud in different ways were so enormous that it was really ridiculous to say this measure here prevents tax fraud. A similar case historically happened in Germany. That was the famous Eurowings case, where the case was around or about the former treatment of add-backs of rent payments for assets leased by a company in Germany, if the rent payments were made to a recipient who was not subject with that amount to trade tax. Then the rent payment was not accepted as a business expense for trade tax purposes, but added back to the tax base. The aim was the people wanted to prevent that by use of rent contracts and lease payments, the profits of the businesses were artificially lowered down and all the money generated in the business sector ended up in the hands of non-taxable private persons receiving lease payments. Legitimate aim, nice idea, but then somebody stood up and said, well, there is at least one municipality in Germany, the small hamlet of Nonindiscriminate, which takes a tax rate under trade tax of 0. And now if you make a rent payment, a lease payment to a business in Nonindiscriminate, then it will be subject to trade tax, so there will be no add back. And then the tax to be paid will be 0. So, and that doesn't really bother you. So the whole concept then was evidently nonsense. If a well-known and generally accepted loophole existed by which every clever person could do exactly what the rule was meant to avoid, then the rule accepted loopholes clearly, and so it was not able to reach its aims, so deserved no protection. Later, by the way, Germany changed its legislation. The add-back was then made for all lease payments, and also the case was the reason why later by a change of the trade tax legislation. Germany forced all cities in Germany to take at least a 200% trade tax rate. Well, but you see here, there have been cases in the tax area where it has been pointed out, okay, that aim, what the measure officially aims at, cannot be reached because the system established by the local legislator has so enormous loopholes that one cannot speak of a general chance to reach that aim. Good. Now, third criterion, very often relevant, if the measure is adequate, can reach its aim, then the next question is, does it more than necessary inflict the fundamental freedoms? Can a milder means be found? That's often difficult to prove because it's hard to say, well, you could have a milder measure because another state practices a milder measure. Then you could say, well, in their culture, the milder measure works, not in our culture. Or they are willing to accept more, let's say, more possibilities of tax fraud or a higher percentage of cases which go wrong in practice. We don't. We want to have a proper solution. So it's difficult to prove to a state you are stricter than you need to be. Usually the way how you can prove this is if you look to the legal system of the state and point out, yes, in your own legal system for comparable problems, there are milder solutions and they are working. Sometimes, however, it is possible that judges say, based on mere common sense, there is a milder measure which evidently works in a comparable quality, and there is no reasonable argument why somebody could refuse to take refuge to that milder measure. So not always do you need to bring forward a comparison from the state's own behavior. You also have that absolute argumentation, which is possible, but whenever you can find a milder parallel, or milder behavior by that same state, this gives you a proof. So if an exit tax is demanded, if somebody moves abroad, then the aim is to prevent that money is lost for the state which has already been generated, and the only thing which is still missing is a formal realization. So the aim is to prevent arbitrary losses of tax revenue. The measure to say if you leave, you have to pay a tax on all that income which has already been caused is also able to prevent the loss of tax revenue. Now, if you say you have to pay that tax when you leave, although you do not have cash at hand, you have not yet sold the assets or so, then the effects are evidently harder than they need to be. You could also preserve your right to levy a tax by just writing a tax notice at the moment when you leave and then collect the payments later, for example, in different installments over a longer time. That would automatically be milder. And here, no reasonable argument can be seen why that should be denied. So here the ECJ has in former times argued that immediate collection of a tax, although no money is at hand from an economic transaction, is automatically too excessive in such a case. And so that the states have to turn to the milder measure. Criterion number 4, the non-discriminatory treatment of an event in comparison to other events with the same problem by the same state. So if the first 3 conditions are fulfilled, legitimate aim, measure is able and also necessary to reach that aim, then you can still argue that in other comparable situations, the same state doesn't bother about the problem as much as in this case. So if they are more negligent, careless, or more generous in other constellations, you can ask them why not same generosity here, because the existence of the more generous solution in comparable situations shows that the measure in question, strict as it is not necessary for the functioning of your legal system in practice in that country. That state itself admits it by having this more generous solution for other cases. They, in general, or they admit by that, okay, the exact solution is not really necessary because I renounce on it in other constellations. Historically, there was a nice example. The German fiscal authorities for a time had the custom that always when they made a tax audit in a bank, they copied all documents about so-called CPD payments to bank accounts in Luxembourg. These so-called CPD payments were known to be often a vehicle for money transfer made by people who had a strong and hard inclination to tax fraud. And so every bank transfer on a CPD account in Luxembourg was copied and communicated to the tax inspectors who were competent to deal with the cases of the taxpayers involved. Now, the idea was we want to follow up potential tax fraud cases and we want to catch the tax fraudulent people. But now the problem was that CPD transfers also existed inside Germany, and the fiscal administration did not systematically not copy CPD transfers within Germany. So, although the measure was motivated by a legitimate aim, we want to catch tax frauders, the measure was able to catch them, and it seemed necessary. Without the information, you can't follow up if these people declared their taxes honestly. Everything's fine. However, the measure was still discriminatory. Why only prosecute or look for tax frauders which use Luxembourg for their tax fraud, instead of also looking to the inland suspects? That was criticized as a discriminatory treatment, so unjustified. And when the case came to the Bundesfinanzhof in Germany, the BFH accepted the argumentation of the bank in question and ordered the fiscal administration to stop this practice. They did not even ask the European Court of Justice for a comment if that could be seen as discriminatory and therefore unjustified, because they said from the standing jurisdiction of the court, this behavior is so clearly unjustified and discriminatory that there is not even an open question on EU law which we could ask the ECJ to answer. This is already so clear that we can immediately decide and forbid the fiscal administration to do what it does, to restrict such measures only to bank transfers to Luxembourg. Some additional remarks. Sometimes there is something like a direct discrimination or a direct restriction, where you discriminate on grounds of citizenship or where you directly forbid a transaction or inflict negative impacts on a transaction because it has to do, and only because it has to do with the foreign country. It's nearly impossible to justify such a direct discrimination because it's forbidden to make distinctions on ground of citizenship. And so if only citizenship leads to the distinction and all the rest of circumstances can be the same, then it's clear that there can be no justification. Because if all the other circumstances can be identical, there can be no difference in the situation which justifies a different treatment. In that constellation, so with the direct discrimination, there are only two ways out of the problem for the member states. The first is you can naturally, as a member state, point out successfully that the measure in question regards a situation which is not protected or subject to any EU law rule. So if you legislate on something which has nothing to do with EU law, you can still do whatever you want. For example, EU law applies to elections for local councils, but not for national elections. So in a national general election, you still can restrict the voting right to your own citizens. You are not forced by EU law to grant the right to vote in a general election also to foreigners from the EU, because general national elections are nowhere covered by EU legislation, so you can do whatever you want. Now, if you fail to point that out, if you legislated in an area which has to do with EU law, then discriminations are forbidden. Then the only way to talk yourself out of the problem is to point out that the situations for the foreigner and the situation for the own citizen are never identical, so that there is a difference in the circumstances. And if there are two situations which are not comparable, then you cannot demand equal treatment. Indeed, these are the two lines of defense which in such a case are usually tried by the member states. And that is if you discuss about discriminations where directly citizenship plays a role, not residence or other indirect discriminations. Where a direct discrimination plays a role, there you will have to expect such defenses brought forward by the member states and have to try to contradict them successfully. Well, the same is probably when it comes to restrictions. There one has to debate, well, it might be that there could be a rule which really effectively hinders the use of a fundamental freedom, so which is so strict that it does not only make the usage of the, let's say, freedom of establishment less attractive, but really makes it virtually impossible for the average citizen to make use of that freedom anymore. Such a restriction cannot be regarded usually as implicitly tolerated by the treaty. So if the impact on one of the freedoms is so hard that virtually nothing remains in practice, then you cannot reasonably assume that the treaties were fine with that. Also, a kind of direct discrimination between two countries would be problematic. Because if you just reject to treat something alike just and only because it happens in a certain country, then by definition all the other aspects of the situation could be identical. And then if they could be identical, there can be no difference in the circumstances which we could justify a different treatment. In former times, that was a problem for 2A ESDG in Germany, which said certain losses from investments or activities abroad are automatically banned from deduction because they come from a foreign country. Now 2A losses, well, the 2A application became only relevant if all other tests, tax abusive behavior, anti-tax saving rules against artificial losses and other things, if all these rules, which were justified by legitimate aims, had already been successfully passed, then the remaining losses could still be killed by 2A, just because they came from, let's say, France. And so it was difficult to say there is any justification for that. it could be imagined that a loss could only be cancelled because it came from a foreign country. And so that could automatically not be justified. Um, the only way how you could justify it would be to point out that in such a case, the other circumstances could never be identical, so that the situation could never be comparable. But that didn't succeed in the case of 2A, which is the reason why the German 2A rule on foreign losses can nowadays only be applied to non-EU countries. Well, let's go on a bit. What, by the way, if we look to other countries, are fundamental freedoms applicable to investments or income from other countries? Well, other countries, the countries of the European Economic Area, are covered by the freedoms too, because the EU and the EEA countries agreed on granting each other all the fundamental freedoms apart from the freedom of movement for private reasons. So nearly every economic cross-border activity also can be criticized under the aspect it's a forbidden restriction if you have to do with something in the EEA or if an EEA citizen does something within the EU. In relation to Switzerland, bilateral agreements between the EU and Switzerland extended some of the fundamental freedoms to the relationship between EU and Switzerland. For example, the freedom of establishment has been granted for natural persons, the freedom of workers exists, and the freedom of services. So whenever something happens in the relation to Switzerland in these areas, you can test according to the usual circumstances and tests if it can be a forbidden restriction or not. So here you have a certain third-party effect. To the rest of the world, third countries, the freedom of capital has unilaterally been granted. So a capital investor from, let's say, South Africa has to be treated in the same way as a capital investor from Germany in Germany. And capital investment in South Africa by a German have to be treated by Germany in the same way as a capital investment in Germany. So restrictions are forbidden. Well, now the details sometimes bring a bit of a problem. For example, the tax authorities have always been very, very reluctant to draw consequences from these freedoms with regard to third countries. They always wanted to prevent that, and so they tried to bring arguments why in the relation with third countries they were still free to do what they wanted. The arguments have usually been rejected by the ECJ, but there was one major argument which was brought forward and accepted, probably for diplomatic reasons. The fiscal authorities brought forward that, for example, the EEA states they did not take over the obligation to implement also the tax regulations and tax directives of EU law. So what they especially were not obliged to do is to take over the EU directives and the EU regulations on the mutual cooperation of tax authorities. No mutual exchange directive, mutual exchange of information directive, and no directive on the mutual assistance between the fiscal authorities of the member states was to be implemented in an EEA state. And so the fiscal administration said that's a difference. The legal framework is not completely identical, that the obligation to pass over information to us does not exist. That makes a difference which renders the two situations not comparable. And if it's not comparable, it's not a discrimination or not a restriction, and so we are free to do what we want. Now, basically, this argumentation is a bit strange. Because what we do here is we say, if we tax you with money from a third country, then you must know we can only tax you with money from a third country if we know that you have this money. Now, if we tax you with that money of which we know, due to information which we have either got honestly by you yourself or by some other source, then we must tax you stricter than it would be normally justified on grounds of the reason that you could have lied and hidden the money from us. So the idea is we tax you stricter than if you had invested in other countries with the money about which you honestly informed us, because you might have hidden it from us. This is evident nonsense. And so in the long run, it could probably not stand criticism. Why it has been brought forward and tolerated by the court is evidently the idea, well, these third countries, we want still some possibility to negotiate with them about things. And so we want to get rid of that treaty obligation to grant them equal treatment already without any claim that they also have to grant us something. So one wanted to escape the own generosity here, and the court evidently has silently tolerated that under a pretext, because we can, if we look to the logic of that argumentation, we can only see it as a kind of a pretext. It really defies reason to say, you told us you have 100,000 in a foreign country, well, and we tax you with additional taxes for these 100,000 because you could have hidden them from us. Well, you didn't. Well, and to say, I must tax money stricter because I do not know of its existence. What would that help if you do not find out about that existence of that money? Completely senseless, but accepted as a justification, probably for political reasons. Now, fortunately, the ECJ draws the line exactly there and says, well, in cases where this justification does not apply, we do not accept that the situation is not comparable, then we say it is a discrimination of a person or of a cross-border activity which is in play. So all the three EEA states, for example, have signed and practice double taxation treaties with Germany in which they grant a comparable, sufficient cross-border exchange of information and mutual assistance. So between Germany and the three states of the EEA, the argument that a discrimination cannot be seen because the legal framework is different can no longer be upheld. So at least for Germany, the rule is the three EEA states have in the tax area a fully comparable status to all the other states of the EU when it comes to testing of discriminations and restrictions. And now, surprise, under the recent developments caused by BEPS and other things, more and more states begin to take up the obligation to practice a sufficient, wide and functioning exchange of information with the fiscal authorities of the EU member states, because there has been a high international pressure to cooperate. And so that pretext, well, there is no cooperation between the fiscal authorities of the two countries involved. So that means that we need to apply stricter tax rules because the situation is not comparable. That pretext becomes more and more inapplicable. And indeed, during the last years, more and more cases with regard to capital investment in third countries of the world have been accepted by the ECJ, where in the end the ECJ says, yes, this is a forbidden arbitrary discrimination, because as we see here from the double taxation treaty, there is a clause on a sufficient exchange of information, and this also works in a comparable way in practice as it works with other countries. So no reason anymore to say there is not a comparable situation. And so no justification for treating it differently. Well, and now, naturally, there are some additional clauses and special rules in the treaty which sometimes allow to make distinctions with regard to capital invested in third countries or invested by third country people in the EU. Especially Article 64 says there is a standstill clause which says the member states can uphold all restrictions with regard to capital investments from or in third countries if these restrictions already existed on the 31st of December 1993. That was the moment when the free flow of capital was finally established and enshrined in the text of the treaty. So tax rules which lead to a restriction of capital with regard to third countries can be upheld if they already existed on that date. Now this standstill rule, however, does only apply to certain fields of capital investments. For example, direct investments, including investments in real estate property, investments in connection with establishments, with financial services, or with the regarding the permission to trade financial assets in capital markets. If you don't have a restriction in one of these fields, then the standstill clause does not shield it from criticism, so then you have directly lost. Especially portfolio investment is not listed here. So if somebody buys a single share or 10 shares in a foreign company, the standstill clause does not grant any protection for discriminatory or restricting measures made by a member state. This is surprising. There is also jurisdiction on what can be regarded as upholding an existing restriction. The first thing is a restriction did already exist in former times if the material contents had already existed then. So it can be possible that the wordings and the numbering of a paragraph has been changed, but if the underlying rule, the basic core of the rule has been changed, extended or so, then the rule of today is no longer the old rule, and an old rule can only be upheld. So if it once has been abolished, you have not upheld it, you have abolished it, and then you are not allowed to reintroduce a comparable restriction or the same restriction again. So even if you have abolished a certain rule, even for a single second, you are no longer allowed to reintroduce it later. Now, in recent times, there have been added some additional clauses which shield some rules from criticism. The most famous one, but the most mild one, is Article 65.1 of the Treaty on the Functioning of the European Union, because that says the rules on the free movement of capital do not affect the right of the member state to distinguish on grounds of residence or on ground of the place of capital investment. This is the mildest rule because, according to jurisdiction, that has to be interpreted in a narrow way, and it is simply nothing else than what always would have been tolerated under the implicit justification rules. So that is rather a mere clarification of what would also be relevant without that rule. So. Furthermore, the member states are allowed to take the indispensable measures to prevent the violations of their laws. Well, also that is implicitly tolerated, so also that is a mere clarification. Article 65.2 then says if the treaty allows to restrict the freedom of establishment in certain areas, then this cannot be attacked on grounds of freedom of capital. So if something is explicitly or implicitly allowed by the treaty for establishment, for foreign establishment, this is also tolerated by the freedom of capital. That makes a huge impact because the treaty doesn't grant the freedom of establishment to third countries, at least not to most of them. So if specific tax rules relate to subsidiaries, major participations in foreign countries, so things which would qualify as freedom of establishment cases if they were happening within the EU, then one can argue, well, this is a freedom of establishment case. And the freedom of establishment case has not been granted for investment in Mexico, South Africa, and Australia. So the treaty allows to restrict this, and then you can't attack it under the aspect of freedom of capital either. That makes, by the way, it interesting how the line must be drawn between freedom of establishment cases and free movement of capital cases. The European Court of Justice usually says it counts what is more in the focus of the rule. If a rule, for example, only applies to 10% participations, 20% participations, or majority participations, it's clearly referring to freedom of establishment. If a rule, however, affects the holder of a single share and the holder of a 100% participation in an identical way, then this is a rule which regulates the capital investment, and then it will be checked under the criteria of freedom of capital. And that then becomes an important distinction. Okay. The treaty also took precautions that if something happens in the world which requires a reaction, the EU institutions can sufficiently react. Article 64.3 allows measures and says the Council of Ministers can unanimously, so with a 100% majority, decide to introduce measures new which constitute a reduction of the already existing liberalization, but only with regard to third countries. So tax rules which constitute a negative treatment of capital investment in third countries could be reintroduced if the Council of Ministers says with 100% majority, okay, we want to do this. 65.4 of the Treaty on the Functioning of the EU also says if a member state applies something, a restrictive measure with regard to one or several third countries, they can apply to the EU Commission for a permission to do so. As far as such a measure can be regarded as justified by EU aims and can be regarded as compatible with the functioning of the single market. That means the EU Commission can grant permission to practice a restricting tax rule with regard to third countries. But, surprise, this is then open to material review by the ECJ because there are conditions posed here. The measure in question must be justified by aims of EU law and compatible with the common market. And so the Court of Justice can be asked by other courts for a preliminary ruling. Is this measure which the EU Commission has approved really compatible with the common market and with the aims of EU law? And so this is not an unrestricted permission to do whatever a state wants with the permission of the EU Commission. Now the EU Commission could just kick the matter down the road and say we don't decide it. Diplomatic idea. We say neither no nor yes. For such a case, the treaty then says if the EU Commission didn't decide within 3 months after application, the right to decide on the application goes to the Council of Ministers. And if the Council of Ministers with 100% votes in favor of that restrictive measure proposed by a member state, then the member state has got the permission to do as it wants in that way. Okay, now that was sufficient for today. So enjoy that again, a chapter has finished, and I hope to see you again soon for the next small lecture in this area. Thanks for watching, and I hope I didn't talk your ears off too much. Recover well from the lecture and hope to see you soon again. Thanks.